Hello and welcome. Today we're working on the top 15 financial functions in Excel. As you know, Excel is powerful. Lots of financial things you can do with Excel. So let's get started. My name's Jeff from Finally Learn, or Help You Finally Learn Financial Skills, including Excel. Now, I've broken down the 15 into 3 different categories just to kind of work on them 3 different times here. So I've got the basic 5, we'll do those first, then the power 5, and then the extra 5, just as a way to classify how this works. So let's talk about future value here. Future value is the idea of if we invest money now, what would the amount be in 5 years or 10 years or 20 years or whatever. So I encourage you to build templates so you can solve future problems. So I'm going to just kind of go slow on these first couple of ones, and then once you get the hang of it, it'll be easier for you to understand how this works. So these 5 are our basic financial functions: the future value, the amount in the future; the present value, the amount in today's dollars; the payment could be positive or negative in terms of adding to an account or paying off an account or whatever; and then what is the rate of return, the interest rate; and then the number of periods. So these are the 5. We'll go through these 5. These are the basics of all the financial functions, or what's called time value of money. Those mean the same thing. So let's say let's create a problem. Let's say for 10 years, and we're going to do it monthly, so we're going to put this as 12 periods per year. And we think we can earn interest, let's say 9%. And let's say we just put in $1,000. We put in $1,000 as our investment and let it grow at 9% for 10 years. Well, let's say we're not going to put any investments in right now, and then the payments happen. Even though there are no payments, we're going to assume payments happen at the end of the period. So we put a 0. That's the way Excel works. Now, I encourage you when you get started with Excel to use the formula builder, and up here on the formula bar, you see the FX for function. We can search for FV, and FV is future value. So I need to know the rate. The annual rate is 9%. Now, careful here, we need this to be a periodic rate because we said it's 12 periods per year, so we're going to divide by 12. So this is monthly. The number of periods is not really 10 years, but 10 times 12. It's 120 months. The payment is 0 right now. We'll change it. And the present value is 1,000. The payments happen at the end of the period. So how much could it grow to? Well, it grows to a negative 24.51. Now, another thing that confuses people when they first learn time value of money and Excel and the calculator, if you're using a calculator, is present value and future value are opposites. One's a cash inflow, one's a cash outflow. Since we said, hey, enter this as positive, then we know the future value is going to be negative. So at the very beginning, in front of my formula, I'm going to put a negative, so that means our future value will come out to be a positive number. All right, so let's look at this. So we invested $1,000, we got 9% return over 10 years. Then our account would grow from $1,000 to $2,451. Now, you say, well, I'd like that, but I'd like to put a little bit more money in. So I'm going to put in $100 a month. That should make the account grow. $100 a month for 10 years times 12 months, that's 120 times you're making a $100 payment. Now you have $21,802. So this is a template, and any other future value problems that you ever have, you could just plug in what you need and solve. It'll solve for future value. So let's look at our problem just for a second here. I'm putting in the payment and the present value as positive. What if you had $1 million and you're withdrawing? Well, let's show how this works. If you had $1 million and then you say, look, I'm going to withdraw $500 a month, then what would it grow to? Well, you see if we had no payments, then it's $2.4 million. But if we took out minus 500 from that account, then it's $2,354,000. So this solves all future value problems. You don't have to create this every time you need to do a future value problem. Let me go back to my original numbers. Let's say we had $1,000 and we put in $100 a month. Then after 10 years, you have $21,800. Now, all these will work the very same way. So let's do present value. Now, present value is the opposite. So instead of going forward, that's compounding, you're coming to the present, which is called discounting. So let's say we have 30 years. In 30 years, we're going to receive $500,000. And let's do it annually. Let's say the annual interest rate is 8%. We're going to receive $500,000. There's no payment going on. Payments happen at the end of the period. So what is the present value? I'm going to go up here to the FX. I'm going to search for PV for present value. The present value is going to be the rate of return, 8%. Now I'm going to divide it by 1. Not going to be meaningful, but if we change this to semi-annual or monthly or whatever, it's going to make a difference. The number of periods is going to be 30 times the 1, so 30 total years. The payment is going to be that amount, which is 0 right now. The future value is going to be $500,000. The periods, payments happen at the end of the period. And so we'll end up with $49,000. So let's say in 30 years you're going to receive $500,000. What's it worth today? Well, it's worth $49,000. I'm going to make this negative at the very beginning, so my answer comes out to be positive. You can see $49,688. Now, let's change this problem. What if you're not going to receive anything in the future, but you're going to receive, let's say, $100,000 each year for 30 years? Well, how much is that worth? Well, 30 years times 100,000 will be $3 million, but that's worth $1.1 million today at 8%. Now, if you had 0%, which is unrealistic, you can see that's worth $3 million today. So at 8%, it's worth 1.1. What if we increase the interest to 10%? Then the present value goes down to $942,000. Okay, let's keep going. Now you understand the future value and present value, then things will get easier along the way. So let's calculate a payment. Let's say we have 5 years, we're going to buy a car and we're going to pay monthly, so that's going to be 12. And let's say our interest rate is 7.5%. Let's say we're borrowing $30,000. We're paying off the loan in 5 years. The payments happen at the end of the period. Well, what is our payment? So let's say you go buy a car and you say, hey, it's $30,000, 7.5%, 60 months. How much is your car payment? Well, this is an important calculation that you need to know how to do. So let's do the function. Let's do payment, PMT. The rate is going to be 7.5, and we need to divide it by the periods per year, the 12. The number of periods is not going to be 5 years. We're not making annual payments. We're making monthly payments, so 5 years times 12, that's going to be 60 months. The present value is $30,000. The future value is going to be 0, and the payments happen at the end of the period. So our answer is we'd make a payment of $601. We don't want to show it as a negative, so I'm going to go up here and put a negative sign in front of it so it makes it positive. So what's our car payment? Our car payment is $601 if you make this purchase on the car. Okay, so you need to know this. Now, you could take $601 times 60 and you could figure out, well, what's your total amount you're paying for the car? Well, what would this be? 601 times 60. You're paying $36,000 for that car. That's expensive. So you need to know how that works. All right, the next one is we can calculate an interest rate. So let's say let's make it 8 years. We're going to do it monthly. We have invested $5,000. We'll make that negative 5,000, and we made a payment of 250. And then over the 8 years, let's say it grew to $100,000. Okay, fantastic. So what kind of rate of return? In fact, that's too high probably. Let's make it 75,000. I'll make it 50,000. Let's cut it in half. All right, so if you had a investment of 5,000, you put in $250 a month. Now, why are these negative? Well, coming out of your pocket is 5,000 and 250, and you're going to receive the 50,000. That's positive. Now, one of the things that happens is we need to put something as negative, something as positive. Otherwise, we're going to get an error. It won't calculate. So let's show how this works. This is going to be the rate function. So the number of periods is going to be 8 times 12. The payment is going to be 250. The present value is 5,000, and the future value is 50,000. Okay, do you see those numbers have gone in negative, negative, and positive? And the payments happen at the end of the period, 0. And we don't have to guess. I never guess. Excel will guess at 10%. That's fine. The computing power is powerful enough where we don't have to guess anymore. And so the interest rate is 0.91 per period, right? So we need to multiply that times the periods. So what kind of rate of return did you get? You got a 10.92% rate of return over the 8 years. Now, if you end up having a problem, sometimes people will message me and say, let's make it even easier. Let's say you put in 5,000. Let's say we put in 10,000 and it grew to 50,000. That's a 20% rate of return. But if you put in this as a positive 10,000, people say, well, 10,000, then it doesn't work. It's not working. Excel's not working. Well, you need to be smarter than Excel. You need to make the present value negative, what you paid and what you received. So if you paid, let's say 15,000, and you received 50,000, then it can calculate this as a 15% annual rate. You can make it annual, not monthly, and it'd be a 16.24% rate of return. All right, last one on these basic 5 here is the number of periods. Let's say on the number of periods, let's say you have a credit card. Okay, so I built this to be like a credit card, and the credit card interest is 20% annual interest rate. But you're paying this monthly payments, and you owe $5,000, and you think you can make a $100 payment every month. Well, how many months does it take? And you're going to pay it off where it's 0. How many months does it take to pay off this credit card? Well, let's see how this works. This is number of periods, NPER. All right, the rate is going to be 20% divided by 12. So that's the monthly rate. The payment is a negative 100. The present value is a positive 5,000. The future value is going to be 0. The payments happen at the end of the period. And so it's going to take you 108 months to pay off this loan. If you want to convert this to years, convert this to divided by 12. It's going to take you 9 years to pay off this loan if you're making $100 payments. So what you want to do is you say, well, I want to pay $150. I'll pay $150, and you cut your time in half from 109 or whatever it was to 49. So more than half if you just increase your payment by $50 a month. All right, so that's the first 5 that are important. The next 5 are net present value and internal rate of return, and then another way to do net present value, and then 2 other ways to do internal rate of return. Okay, I'm editing this video because I did net present value wrong in the previous example, so I'm just editing NPV and IRR, and you'll get back to the regular video. Well, net present value says, look, what if we have an investment and the investment is $10,000. So that's in time period 0. And then over the next 4 years, we return positive cash flows. Now these are cash flows, not profit, but cash flow. And so what is the net present value? Bring it all back to present value and subtract out the $10,000. Well, here's our formula. The formula is NPV. We need to know the rate, and we say the hurdle rate. In other words, we want to accept it only if it's greater than 12%. That's the minimum we'll accept. And then the values, I'm going to grab all the positive cash flow values, or the cash flows year 1 through 4, really. Some of them could be negative, but not the very first year. And so we'll hit done. Now that's just the present value of the stream of cash flows years 1 through 4. So then we need to subtract out the 10,000. Since the 10,000 is already negative, just add the 10,000 that's negative. It subtracts it out. So the answer is 837. So because it has a positive net present value, then we would accept because we know we got greater than a 12% return. Now let's compare these two go together, the net present value, internal rate of return. So basically internal rate of return is what is the return that you receive. If you invest 10,000 and then you collect 2,000, 3,000, 4,000, and 6,000 over the next 4 years, then what is your rate of return? So let's do internal rate of return, IRR. We're going to grab all the values, including the negative 10,000 and the positive numbers. We can guess, we don't have to guess. Hit done, and it's 15.28%. Now these two are related. If I go back and put 15.28% as my hurdle rate, then my net present value is 0. So the internal rate of return is the rate of return that makes net present value 0. If we go back and change net present value, the hurdle rate, to 10%, we have a larger number. 12%, we have a smaller number. And at 15.28%, you see it's 0. If we required a 16% return, then net present value becomes negative. All right, let's go, same problem. Let me show you how to do it one different way in net present value and two different ways in internal rate of return. All right, so we have the same problem. Now, for the XNPV, that's the newer function, we now have the same hurdle rate, we have the same cash flows, except now we have different dates. So the dates make a difference. So let's do XNPV. Search for XNPV. So now we need to know the rate, which is 12%, the values, the dollar amounts, and then the dates. See, regular NPV just assumes annual annual years. The periods are the same every time. This one we can set different dates. And so it's based on the actual dates rather than an assumed equal periods. So the net present value in this case is 1821. We would accept the payments are occurring just a little bit faster than an annual basis. Okay, same thing with internal rate of return, XIRR and MIRR. So the same kind of thing, we have the amounts and we have the date. So XIRR is the same kind of calculation. So let me search for XIRR. Same thing here, we need to know the values, the dollar amounts. We need to know the dates. We can make a guess, I'm not going to guess. And it here is 15.28, which is the same amount as previously, because here I forced it to be equal dates. If we don't have equal dates, let's say we have 4/1/21 and 5/30/22, you see as the dates change, the internal rate of return changes. So therefore, this is an IRR based on different dates. Now the last one for this, for internal rate of return, is modified. And what it does, it calculates these numbers. It has a finance rate, it has a reinvestment rate. All right, so let's go back and let me show you how this works. I think it was 15.28 was our number. So what we would have is a modified internal rate of return says, look, in fact, let me show you here how it's different. It uses a finance rate and a reinvestment rate. So does it cost you money to borrow the $10,000? And then if you get the $2,000 in, are you reinvesting that at a certain rate? So the values, we have the finance rate and we have the reinvestment rate. Now, one of the challenges with internal rate of return, it assumes that you're reinvesting the cash flows at the IRR, which may or may not be successful here. So let's take the reinvestment rate. Let's say it's only 3%, and let's say our cost of financing is 8%. Then our modified internal rate of return is going to be 11.56. So we can use this with the cost of financing or the cost of reinvesting. All right, we've done our next 5, so let's do our last 5 here. And so future value schedule is our next one, number 11. So let's say we have future value, but in year 1, we can earn 5% and then 7% and then 8% and 10% over the next 4 years. So what would happen is we're not earning a steady 7%, we're earning a different rate each year. Well, you can handle this with future value schedule. So future value schedule, we need to know the principal amount, it's $10,000, and we need to know a schedule of different interest rates. So this assumes equal years, so we get $13,347. Now, we could change these interest rates to 7%, 8%. We think it's going to be 5% and then 9%. We can do that, and the numbers change on future value schedule. So we can do a future value with differing interest rates. All right, the next one, number 12, is stock history. Stock history, I'm going to use the next tab. Here's what it does. It pulls stock prices from previous years or months or whatever. Now, we need to know, let me go back and show you, we need to know several things: the stock ticker, the start date, the end date, so on. So I've already built this, and let me show you how this works. So I know Apple is AAPL, that's the ticker, and I did the start date is July 1st, and the end date is July 31st. So in this cell, I did the stock history. So let me delete this and do it from scratch. You just need to know these ahead of time. So stock history, I need to know the ticker symbol. The start date is July 1st. The end date is July 31st. Now, I'm going to go ahead and edit here. I'm going to do comma, and the first option is the interval. Do I want this daily? Do I want this weekly? Do I want this monthly? Well, if you have 10 years of data you need to pull, monthly might be fine, weekly might be fine, or daily. I'm doing 1 month, so monthly is not going to give me very much information. Weekly will give a little bit more information, but daily will give me the most information. So I'm going to put daily, and then I'm going to do comma. And do I want no header, or show the header, or show the ticker and the header? So yes, I want to do that. And then the last thing is, what information do we pull? Now this one, we can do this multiple times. I want to do the date, do the comma, and I can do it again here, and the close. I'm going to hit enter. And what it does, this does a search. It pulls, based on Apple, it pulls the daily. Anytime there's a stock day that the stock market is open, there's trades, it pulls the daily prices, the closing price of Apple. Now we can change this. If we did WMT for Walmart, then it changes, the dates are going to be the same, but then the price is different. So this is a very helpful way to get stock prices into Excel very, very quickly, and then you can work with that as a number and so on. All right, the last couple of ones are a little bit smaller here. Number 13, let's talk about the principal payment. Sometimes we want to know of our payment, how much is principal, how much is interest. And so I'm using the same problem I did in number 3. Remember the car payment? We did a $30,000 car loan, 7.5% for 60 months. Well, how much is the principal payment? So PPMT. So I'm going to search for PPMT. So I need to know the rate. Well, the rate is 7.5% divided by 12, so it's a monthly rate. What period are we talking about? The period is, let's do period 1. The number of periods is going to be 5 times 12. What's the present value? The present value is the $30,000. What's the future value? We're going to pay it off at 0. The payments happen at the end of the period, so we'll put a 0 there. And I'm going to make this positive by putting a negative. Negative, negative is positive, right? So $413. Now, here's what this says. You're going to make a payment of $601 every month. The very first payment, you're going to pay off $413 of the loan. That means the other $180 or so is going to be interest. And so you can do the math on that if you want to subtract that out. But what happens in the last period? Period 60, $597 is going to be principal of the 601. So this is helpful to figure out how much of your payment of 601 is principal versus how much is interest. All right, number 14. We sometimes need to calculate a rate of return, and the easy way to calculate a rate of return is using the RRI function. I'm going to delete this here and show you how to do it. RRI. I need to know the number of periods. This is 10. The present value is 2,000. The future value is 6,000. Now, this is one of the time value function problems where you don't have to put in it as a negative. It knows that this is just a rate of return. It's going to assume present value is negative and future value is positive. And so let's calculate what is our rate of return. Well, it's 11.61% annual rate of return, or CAGR, compounded annual growth rate. Well, you can change these. It could be 8%, 8 years, and the percent goes up because you have a return over 8 years rather than 10. If you went 18 years, then that's a smaller interest rate. So let's go back to 10, and let's say you invested $8,000 and it went down to 6. Well, you've lost 2.8% each year. All right, the last one, number 15. Sometimes we are given an interest rate and we're given the periods per year, and we want to calculate what is our effective interest rate. Well, this is based on the periods per year, so we're going to calculate the effective rate. The effective rate, the nominal rate is 11%. The number of periods is 12 per year. So hit done. That's like getting an 11.57% rate of return. Now, if there's only one period per year, then 11% is 11%. If there's 2 periods per year, it's going to be slightly higher at 11.3%. All right, this is how you do all the 15 top functions, financial functions in Excel. We'll see you on the next video. Thanks for watching. Appreciate a thumbs up, appreciate a comment, and we'll see you on the next video.